Welcome back, my friends. Corporate and institutional investors are preparing to become even bigger landlords. Homebuilders are sounding the alarm bells about demand for new houses. This week, D.R. Horton, one of the nation's largest home builders, sounded the alarm. Demand for new homes is softening significantly. Traffic in model homes has thinned out a lot. And contract cancellations have spiked. The United States is teetering on the brink of a recession. And a record number of new houses are coming onto the market in many cities. Sensing that home prices are in free fall, home buyers are now pulling back from the market. But guess who is stepping forward to buy houses in bulk at rock-bottom prices? You guessed it, Wall Street institutional investors. Private equity, Wall Street banks, and corporate interests are gathering their cash. They want to bypass the usual home building food chain and make build-to-rent deals to buy in bulk from homebuilders and house portfolio holders. So, is this a good thing? Will it even work? Or will these moneyed interests fall victim to a further crash in the housing market? What does this mean for new home development? What does this mean for the future of the economy? And what does it mean for the future of the United States? But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Well, my friends, get ready for the expansion of corporate landlording. Institutional housing investors, largely the commercial banks, private equity, and other financial entitles, that flip homes or rent them out. On the one hand, we're told investors are buying up more housing than ever. In 2021, they bought nearly 1 in 7 homes sold in the 40 largest U.S. metropolitan areas, the most in at least 2 decades. In the first quarter of 2022, investors comprised between 1/4 and 1/3 of home sales. In Atlanta, Jacksonville, Charlotte, Phoenix, and Miami. The U.S. House Financial Services Committee reported in June that corporate ownership of single-family rental homes has grown 3% annually since 2010. With the third quarter of 2021 posting the fastest year-over-year increase in 16 years. These trends are worrying, researchers and advocates stress. Because there's evidence that corporate landlords, under pressure to deliver big profits to their shareholders, are more likely to evict their tenants, raise rents more aggressively, and shirk responsibility for basic maintenance and repairs. There's also evidence that some investors have been targeting homes in black neighborhoods at disproportionate rates, accelerating gentrification, and putting homeownership for some families further out of reach. On the other hand, housing owned by large corporate investors makes up a much smaller percentage of the nation's overall housing stock than is often suggested by headlines. Institutional investors, referring to entities that purchase 100 or more properties, accounted for under 3% of home sales in 2021 and 2022, according to Freddie Mac. So-called mom-and-pop investors, who own fewer properties, are growing at faster rates, and according to the National Rental Home Council, only 1.16% of single-family rental homes were owned by rental companies. Americans for Financial Reform estimated that as of June 2022, private equity firms owned about 3.6% of apartments and 1.6% of rental homes. Defenders of the sector point to research showing that most people moving into single-family rentals are poorer, younger, have worse credit, have larger families, and are more likely to be single parents than their home-owning counterparts. One study published last year estimated that 85% of single-family rental residents would not qualify for a mortgage. Taking away these rental options, advocates warn, would just take away more spacious living arrangements for younger families who can't yet afford to own, or might not want to even if they could. Others say the focus on Wall Street investors is largely a scapegoat to avoid wrestling with the real culprit of the housing crisis: the dearth of available units. Sam Cater, the chief economist of Freddie Mac, cited labor shortages, land use regulations, zoning restrictions, political opposition to new housing, lack of developers, and lack of land as root causes of the housing shortage. Work from home has increased home prices by 15.1% since late 2019. 3 Democratic House members from California introduced a new bill to slow home purchases by institutional investors. Senator Sherrod Brown said the bill is focused on predatory investors and landlords. U.S. Representative R.O. Khanna said he doesn't see his new bill as a comprehensive housing solution. He says that lawmakers need to focus on fighting barriers to new housing construction, increasing housing supply, and expanding down payment assistance. But we don't need to be subsidizing institutional investors, Khanna added. They go buy up housing in working-class neighborhoods and holding them for appreciation and turning them into Airbnbs, Khanna also said. You could make an argument that it was necessary to subsidize Wall Street investors after the 2008 financial crisis when the market collapsed, but that certainly now has run its course, Khanna also noted. The goal of the new House bill is to deter future institutional investments into single-family homes by barring corporate investors from claiming certain tax breaks like the mortgage interest deduction, and imposing a transfer tax on the sale value of new single-family home purchases. Increased building costs have already led to a slowdown in investor home buying. Redfin also just closed its own home flipping business. Open Door Technologies, another online house flipper, which just posted record losses. But demand from institutional investors still accounts for 17.5% of all home sales in Q3. Even if institutional investors only buy up a small percentage of total housing, their presence in the bidding wars can still lead to higher costs for all buyers. For now, institutional investor purchases have slowed. But experts expect their share of purchases to rise again soon. Home builders are looking to sell unsold homes in bulk to institutional landlords. And institutional and corporate buyers are raising funds of over $100 billion. They are preparing to pour billions of dollars into new build-to-rent communities. Tricon Residential has nearly $3 billion it plans to use to buy and build new homes. We need to massively increase housing supply, said U.S. Representative R.O. Khanna. J.P. Morgan Chase has formed a new venture with a billion-dollar real estate developer. The partnership is morphing America's largest bank, America's largest landlord. This starts with thousands of U.S. rental homes. J.P. Morgan announced that it has formed a joint venture with Haven Realty Capital. The joint venture will purchase and develop entire communities of new homes. It is starting with 3 communities in the Atlanta area. Enough capital to acquire more than 2,500 single-family rental houses will be invested. The build-to-rent, BTR, gained immense popularity during the pandemic. Actually, it paired 2 separate but willing constituencies. COVID-quarantined city dwellers were eager to move to the suburbs for more space. Real estate investment funds ready to capitalize on this by developing full-on, turnkey communities. A community is far easier to manage than a disparate group of properties spread across multiple parts of a city. Under the BTR model, housing developments are built on spec, which means without an agreed buyer. The builder tries to get a property management company to buy the entire community of houses as a block. Then, the property management company rents out and maintains all of the community's properties. It is somewhat similar to city rental markets, with the exception that freestanding single-family homes take the place of apartment units. The amount of rental houses increases when property prices and mortgage rates soar. This year, both factors are rising aggressively. Haven already owns 3,500 homes valued at $1.2 billion in 35 communities. Most of these houses are completed, but some under construction. JP Morgan's injection of capital could increase that portfolio by 70%. Haven founder Sudha Reddy says that now is the time to invest. Home building is basically grinding to a halt as home builder confidence collapses. But, if you follow this channel, you already know that big home builders are losing confidence. D.R. Horton, the largest U.S. homebuilder, shared more details in its Q3 earnings call this week. Among the many notable highlights, buyers canceled almost 1/3 of all purchase deals in with D.R. Horton in Q3. Orders for new homes fell 15% to 13,582 homes as compared to Q3 of last year. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.